Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Chris White, CEO of BondCliq, for his 2021 outlook into the fixed income market and how the structure is evolving with digitization. Chris, it's great to see you as always. Welcome back to Trade Talks.
Great to see you too, Jill, which was in person, but we got to do what we got to do in these times.
Yep, hopefully back half of next year. Let's get into fixed income for the moment. How will the new administration potentially impact fixed income? Any thoughts on regulatory changes?
Yeah, I think that obviously we've already seen some seat changes. We've seen a new Treasury Secretary coming in Janet Yellen, who we have some familiarity with in terms of her time at the Fed. We're also seeing some turnover at the SEC. It will be interesting to see whether or not we see the regulatory mandates sort of uptick when it comes to fixed income markets. Something that did happen that went noticed by the SEC, I would say around the COVID times going into the summer, was just how poor the quality of pricing was when it came to corporate bonds and how that impacted the ETF market. And they've actually already started to put out some language around regulated price transparency. So I would predict that conversation continues into 2021, absolutely, for fixed income.
What could happen to fixed income markets without pledged central bank support, or as much as we've seen?
Well, I think that's why a lot of people are applauding Janet Yellen in the Treasury seat, because she said publicly that the market needs a lot more stimulus. I think it's been quite obvious just looking at the way the market has reacted to what the Fed is saying, that people who are investing are relying on the Fed to keep the market solvent. So even though there's been some discussion of Mnuchin potentially shelving the remaining CARES Act money and making it a little bit harder for the next administration to use it, I predict that just what regulators are going to do and what the Fed's going to do is continue supporting credit markets, especially because there's a huge, massive wall of debt that's coming due for U.S. credit, or actually for global credit, and there really isn't an answer as to how a lot of these companies are going to pay for it.
Right, and I guess that's really what the concern is, because it eventually will impact structure at some point. So let's talk about market structure a bit here. Why is there an explosion in new primary market platforms, and are you concerned at all about fragmentation?
Well, the primary market explosion, it's really timely. I think people have been working on new ideas around primary markets for the past decade now. But it's timely because this year, particularly in the U.S. credit markets, we've seen just an explosion of new issuance. I think that the record for new issuance was broken back in September. So we're going to hit massive new highs in terms of new debt that's coming to the market. And as I mentioned before, with all of the bonds coming due for companies, I think that there's a couple of $1 trillion, or at least the S&P estimate is it's 12 trillion globally. I don't know what the number is for the U.S. market, but those bonds are coming due within the next 5 years. So these companies have to refinance, which means that they have to issue more debt. So I think that's why there's a lot of focus on new issue technology. In terms of fragmentation, it's a little bit different. The term fragmentation in the secondary market is used to discuss how difficult it might be to do a large trade because there's so many different platforms offering the same security to trade. But I think that the fragmentation issue is a little less of a problem when we're talking about primary market technology, because if the dealers and if the issuers are behind a particular platform, then all of the bonds from that platform are really going to be offered out in that single solution. It's not like you're going to see multiple new issue offerings across multiple new issue platforms. It will be, for the most part, centralized. So I think while there's some concern, you're not going to see the same effect as what you would expect if there were multiple secondary trading platforms.
Let's talk about portfolio trading and how it has helped address secondary liquidity issues in the corporate bond market.
So yeah, this has been the rage. We heard a lot about portfolio trading, I think, in 2019. But in 2020, it exploded. From what I'm hearing from some of the operators who have brought portfolio trading technology into the space and some of the bigger players, that really where adoption ramped up was, surprisingly enough, Jill, in March and April, where you would think that people might be afraid to try new things. But I think what portfolio trading is at its core, it's how the market adapts to conditions of illiquidity. Like, there are flowers even in the desert, right? Because there are organisms that just can adapt to that climate. Well, that's what we're seeing with portfolio trading, where large buy-side shops and non-traditional and traditional sell-side shops have figured out that they can move risk between each other if they do it in a large portfolio. And what that allows them to do is trade bonds within their portfolio that on an individual basis would be very, very difficult or very expensive to trade. But because they're a part of a larger trading package, you can get those trades executed, and there's less weight and there's less cost to the end purchaser of liquidity.
And Chris, finally, to wrap up here, what areas of fixed income are you most constructive on for 2021?
Look, I think that we just saw that S&P is putting out a bid or saying that they're going to be buying market for $44 billion. I think that for all markets, but in particular in fixed income, 2021 is going to be about data. Who has the data? How can you get the data? Who can make the data better? And how can I apply data to my trading process? Now, in certain areas of fixed income, like treasuries, that's a long gone process. That, data clearly is what drives a lot of the algos in the more developed areas of fixed income. But when we're talking about corporate bonds, we're talking about mortgage-backed debt, when we're talking about even structured products, the entire focus, I think, is going to be around data, which is a little bit of a change from what we've been focused in the past, which has really been around execution.
All right, that'll certainly be interesting to watch play out. Chris, as always, it's great to see you. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much, Jill.